Welcome to online lectures by CA Studies. For more lectures online, please do visit castudies.lk.
So under sum of digits method, we will be seeing in two scenarios. One is arrears method. Other one is advance method. In arrears, you have a formula. Both methods you got a formula which is n multiplied by n plus 1 divided by 2. Whereas in advance, you have another formula which is n multiplied by n minus 1 divided by 2. Yeah? Okay. Now, let's use the same example that we used previously. So, previously we know the lease period was 5 years. Yeah, 5 years. N represents the lease period. Okay. Right? So, what you need to do is 5 multiplied by 5 plus 1 divided by 2. Here it will be 5 minus 1 divided by 2. Now let's go with the arrears approach where interest is paid at the end of the year. So, 5 multiplied by 6 divided by 2. What's the answer? 15. How you apply this and find the implicit interest rate for each year is that first write down the years 4, 3, 2 and 1. Then now it is 15. So 5 years must be divided by 15 times. And that must be multiplied by 2500 annual payment. The 2500 lease payment that they gave us in the question, that you should use multiply by 5 divided by 15 times, which will give you 833. This is the implicit interest for year 5. Next, year 4 divided by 50 multiplied by the annual monthly rental of 2500. 2500 divided by 4 divided. Likewise, this we have to prepare this table of implicit interest figures and get your total balance of 2000, which will be equal to your annual payment of 2500. Because we divided 2500 by the number of times or the sum of digits each year. Accordingly, it is therefore mathematically it will be the total of all the implicit interests will be equal to the final annual payment. With this we finish the sum of digits method, and next let's go to understanding how to apply down payments when we prepare amortization schedules. That's the only way they are going to ask with regards to down payments. So, a down payment is when a business makes an initial payment or an upfront payment in advance, something paid in advance, right? To reduce the future payments so that they can incur a lower finance charge. So, let's say they have 100,000 lease taken on 1st of January. The owner is paying, or the lessee is paying on 2nd of January 80,000. Then balance he has to pay only 20,000. The leasing company and he agrees to pay it over a 5-year period or so. So this 20,000 will be split into 5 years and you will get your monthly or annual installment of 4,000. So this is basically, this 80,000 is called the down payment. Because of this payment, our annual repayment has reduced. If we were supposed to pay this 100,000 in 5 years, then it would be 20,000 every year. You see? So let's understand how it affects our amortization schedule. See the example. T Limited is purchasing a vehicle on lease with capital of 10,000 rupees. 7.93 implicit interest. Okay. Now when it comes to leases, we have the same amortization schedule just like for loan. But in leases, the interest rate that we use is the implicit interest rate that we calculated as per the previous methods. Fine. So they made a down payment of 4,000. Calculate the interest amount for the lease period. Okay, they are asking what is our interest for the lease period. Now, draw the amortization schedule first, which is for how many years? The lease period, they have mentioned 5 years. Okay, so up to 5. Get the opening balance. Interest, implicit interest. Repayment. So your initial opening balance, should you put 10,000 or should you put 10,000 minus 4,000? Think about it. You're paying interest or the company is charging interest only because we are taking some time to make our payment. We are not going to pay immediately. We are taking time. By taking time, the value of the money that we pay today is not equal to the value of the money we pay later. It means the value of the money we pay later is not equal to the value of the money if we are supposed to pay today. And why that happens? Because of possibly inflation, interest rate. We learnt all of this in the compounding and discounting chapter. Right? Basically because of time value of money. Now, therefore, since down payments are paid immediately, that means today you are signing the lease agreement and today itself you are paying 4,000 upfront payment. As a result, for this 4,000, you will not accumulate interest. Therefore, here the opening balance will be 10,000 minus 4,000, which is 6,000. Now, that's the only change. Thereon, implicit interest, another point to note, it acts as a compound interest. So, what is with compounding? Compounding means you calculate your interest based on the opening balance of each year and not on the original amount. Yeah. So 6,000 into 7.93% is your implicit interest. Let's see how much. 475.8. You're repaying. Okay. Now, the repayment is not given to us. Okay. I just noted it. Now, what is the method to find repayment? The only way we can find this actually is by the present value approach to annuity. Okay, because we have the present value of repayments. What is the present value of repayments? Just make a good guess. It should be the opening balance or the balance outstanding as of today, as of making the lease agreement. Isn't it? That is only the present value. Like the initial loan amount we used to consider as the present value. Same way, leases also, the opening balance of repayments opening balance of the lease is the present value of lease monthly or annual repayments. Okay, so since it will be the opening, I would say opening lease balance, we know that. Because we know that only we can follow the present value approach. If not, we can follow future value approaches, but future value we don't know and the repayment we don't know. Two unknowns, so we cannot reach that figure. Okay, present value annuity formula to annuity because it's a fixed sum paid for a fixed number of years. So, annual cash flow multiplied by annuity factor. Now, we know present value is 6,000. Annual cash flow is what we need to find. Annuity factor, we know it should be up to year 5 and at 7.93% as it is given in the question. So, it should be 7.93% in year 5. What is the value? I think it is not available in your annuity factor table because this is like the previous example continuation. So, we can apply our annuity factor formula, okay, which is 1 over r into 1 minus 1 over 1 plus r to the power n. Since we found in the previous, so this r will be 7.93 and n will be 5 and you got to solve. When you solve, you will get the answer 4. Okay, and you have your annual cash flow and you have 6,000 here. So, therefore, annual cash flow will be equal to 6,000 divided by actually this is not, yeah, this is annual cash flow. It's equal to 6,000 by 4, 1,500. This 1,500 only will be entered in our amortization schedule here. Make a very good note of it. We only follow the present value approach to annuity formula for the repayments and then find our annual cash flow to be put into the loan schedule. Right? Okay, so with that, we can finish off our amortization schedule. That's it. Nothing new. So, rewind how to work out the closing balance. Opening balance plus implicit interest minus repayment. 6,000 plus 475.8 minus 1,500 is 497.8. So this will be 1,500 every year. So likewise, complete the table. Yeah. So this will, interest for second year will be on 4,975.8 multiplied by 7.93%. That will give us nearly that amount. Sorry, this is 395.5. Okay, and then the closing balance therefore will be 3871.3. Likewise, keep on filling the table. Finally, you will get the answer 0.2, which is equal to 0. So, always your amortization schedule should start with opening balance, which is could be the cost of the asset or cost of the asset minus down payment. And finally, if you have done everything correctly, your last balance must be 0, nearly 0. Fine. But the question asks, what is the total interest amount for the lease period? So, we know, oh right, so we have to complete this column. So, this is the total repayment. So, this will be the total interest that we need for the question. And let me rearrange this a bit. So, let me fill this. 5. Yeah. So, 3871.3. Okay, then take the total of this column. 475.8. 1,500.7 is your interest. And what is the total interest plus capital repayment? 7,500. Another important thing to actually note also when it comes to your loan amortization schedule, this repayment is interest plus capital. Okay, that means it includes this 475.8 interest. So for this year it will be 1500 minus 475.8 and what is the amount? 1024.2. So 1500, so this includes 1500 includes 475.8 worth interest and 1024.2 worth capital. Get it well, understand it well, because you're not only settling your interest or loan, you're settling both. You're paying interest and as well as you're paying your loan initial amount, right? So make sure that you are aware of the breakup of this repayment. It includes interest plus capital.
Thank you for watching the video. Stay tuned with castudies.lk for more lectures online.